hikes this year because we're not going to see inflation wane anytime soon. Your thoughts here on the bond market kind of directing equities today?
Well, it's in times like this, Tom, it's always a good reminder to just look at the sizing of the markets, and the bond market is significantly larger, not just in the U.S. but globally, than the equity market. So the equities flash all day long, and you can watch them, and the futures trade all night and all that fun stuff. But the bond market, the corporate debt market in particular, is just massive in comparison to the equity market. So it always can be the dog wagging the tail, right? It is the bigger market, and it can push things around. It just doesn't oftentimes feel like it's happening that way. So we sort of think the equities are driving things, but typically it is the bond markets. And when there's really a kind of a geometric shift there, it does really put pressure on equities, and that's a pretty interesting, and good reminder for everybody out there watching this. Easy way to check on bond price, or you can look at the futures, you can look at obviously treasuries, and then there's tons of bonds offered, but it's just not as exciting to look at, right? You can't go in and kind of get real-time quotes, but plugging the trade desk here, you can always call in and check on quotes if you need to and get information on it. But look, the bottom line here is that rates are up, right? Pending home sales this morning, down for a fourth straight month. Rates are really impacting that, right? Tom, you locked in a rate not long ago, right? They're up significantly since then. So it's going to impact how much of a home you can buy. It's going to impact, what you're willing to put on a credit card. It's going to impact anything where anybody's borrowing money, and then it trickles down from there. So I think it's really important to recognize that these high inflationary numbers that we continue to see are going to drive the Fed. They're telling us they're going to be aggressive. Rates are going to go up for a while, and that is going to keep equities kind of likely in a range, because we can't just continue to outperform with a rate environment like that.
Yeah, that's a great point, Joe. To Nick's, the way that Nick's looking at this. Yeah, I just got a mortgage, but I got a mortgage a year ago that was 1.5 full basis points lower than it is today. The demand out there is still robust for housing, but people are getting priced out of the market, and this will put a scare into you. The 30-year fixed is up to about 4.5%. So that consumer sentiment data, and this was the final read, just a little bit lower. It seems like it's stabilizing just below the 60 level, but we're still at 11-year lows, and this is a forward-looking number that we continually talk about. Your thoughts on that?
This number's huge, and as you mentioned, it really is going to be driving consumer demand going forward. And with consumers representing 70% of GDP, you got to keep an eye on this one. I mean, one of the things that we were looking at the University of Michigan consumer sentiment number that came out today, but if you go to the Conference Board, one of the things that they're showing is kind of the current versus present expectation. That is now at the lowest level that we've seen in multiple years, and we're in one of those ranges right now where it has, I don't want to even say tended, it has predicted or at least led into recessions multiple times in the past, where we've seen that widening. And basically what that means is that as you're looking forward, what do consumers think there are opportunities for jobs, there are opportunities for spending look like in the future. And right now with the inflation, with what we're seeing at the pump, with what we're seeing at mortgage rates, consumers aren't very positive about the future. And what does that mean? That means that they could be curtailing their spending, and that could have a pretty negative effect on GDP going forward. Definitely.
And just going over some of those points that you mentioned here, Joe, the lowest since 2011 as far as consumer confidence as a whole. But I think you brought up something that should be clarified here, is the fact that the expectations component went down to 54.3. In February, that was 59.4. And the current reading
percent tax, the other discourage buybacks through changing the executive compensation, creating a blackout period for CEOs and other executives to sell. But the 1%, is that a huge part of the, I mean, how much money do they think they can raise directly from that? Do you know?
Yeah, I don't know the answer to that, Andrew, but I do know that this is something that Democrats have been kicking around for a long time. This is a frequent scapegoat when they talk about the ways that companies try to boost their own profits while leaving, consumers in the dust here. So this disconnect between corporate America and the average consumer is going to be a common refrain, I think, heading into the midterms. I think you hear about it a little bit, too, around inflation and around the accusations of corporate profiteering. So this is going to be the theme in the budget. The details of this still need to be worked out. As you're talking about the billionaire income tax, Democrats themselves are divided over not whether that's a good idea. The details of how a share buyback tax or restrictions would actually work, I think, would also need a lot of socialization in Congress.
All right, thanks, Elon.
Way of putting it, yeah.
Coming up, much more on all this. The president's new tax proposal. We're going to talk about what it means for the country's richest people next. Plus, Dr. Scott Gottlieb on federal COVID funding and what will happen if the money runs out as other parts of the world are shutting down again. Squawk Box will be right back. Stay tuned.
Some new details this morning about President Biden's budget proposal that has big implications for corporate America. They're going to be supporting legislation that would prohibit executives from selling shares that receive part of their compensation if, and this is important, effectively becomes a blackout period that will be put in place for multiple years if they engage in a stock buyback program. So effectively, a CEO that has compensation vested to them, if they engage in a buyback program on behalf of their company, they would then be limited from selling those shares for a number of years, possibly as many as 3 years after that buyback program, I imagine, is completed. This becomes complicated, of course, for companies that have rolling buyback programs. We should mention the top 10 buyback spenders from 2010 to 2019 are Apple, Oracle, Microsoft, JP Morgan Chase, Wells Fargo, ExxonMobil, IBM, Cisco, Pfizer, and Bank of America in that order. And that's according to a study by the Roosevelt Institute published last May. The study also found that over the past decade, these companies are spending an increasing share of their profits on stock buybacks, as you might imagine. Apple, for example, spending 76% of its net income on buybacks. In the first 2 months of this year so far, S&P 500 companies have already spent about $238 billion towards buybacks, and Goldman Sachs analysts predicting buybacks could reach a record $1 trillion by the end of 22. So they play a huge feature in the market. You take them out of the market, it raises lots of questions.
Well, I would think one of the instant reactions would be that companies would just up their dividends, right? Because if you have that kind of excess capital, you can either give a dividend to the shareholder, or you can buy back shares and make the shares they own more valuable.
But that gets taxed. So, it becomes
but that's what I would think. It wouldn't necessarily drive it to R&D. It's probably just going to drive it to dividends, and sure, then that gets taxed.
But part of what they're trying to do here, I think, is disincentivize buybacks. Dividends actually work out in a different way. There are studies that show that money that's dividended out actually does get used in a different way in the economy in a way that buybacks perhaps don't. So to discuss this and debate it, Donna Edwards, former Congresswoman of Maryland, running again for her old seat. Jim Petticoukis is here, a fellow at the American Enterprise Institute, a CNBC contributor. Thank you both for joining us. I'm going to Jim first, Donna, if you'd indulge me, because I'm imagining that Jim doesn't like this plan, but maybe he does, and I'm curious whether you think this makes sense.
You know, when I hear something like this, I think about what problem are we trying to solve here? Is the problem trying to raise revenue? I suppose that's a problem. Are we trying to signal certain political priorities? Maybe we're doing that. But I don't see the actual economic problem that this is solving. I think there's very little evidence that buybacks are somehow negatively impacting corporate decision-making, that it's making them more short-term oriented. And that list of companies that you mentioned earlier, pretty successful companies on that list. So I tend to think this is more about making the numbers work in this budget and signaling priorities, rather than addressing an actual economic problem afflicting America.
I want to get to Don in just a sec, but Jim, there is, I think, irrefutable evidence that over the last 10 years, when you do look at executives selling their shares, that the amount, both in terms of volume, the timing, and everything else, is materially higher. I mean, on the order of 5 times higher, if not more than that, in the context of buybacks, relative to companies that are not pursuing buybacks. By the way, it makes sense. You would think that people would sell into a buyback situation in part because it is propping and pushing the stock higher.
Well, I guess 2 things. One, that's a data point, right? And then you need to they need to connect that to poor corporate performance. That therefore there are all these investments they're not making.
Jim,
let me finish my point.
Same story, though. Same story. If you look at the studies, you will actually see that companies that pursued buybacks grow more slowly, oddly enough, and maybe it's not odd, than they did in the 3 years prior.
To finish my second point, then you have to say that they are therefore passing up lots of good investments. And I thought like the broad center-left macroeconomic theory here was that we're in a period of secular stagnation where there aren't good investments. So then what are you asking them to do? Where are the good investments that you want them to invest in? You can't have it sort of both ways.
Donna, what do you think?
Well, first of all, Andrew, I think you're making my point, actually, that the fact is that this phenomenon of corporate buybacks is actually increasing over time. You made the point earlier, $1 trillion, the estimates are just this year. And so the goal here is to try to encourage good behavior and discourage bad behavior. That is behavior.
But Donna, are we trying to encourage? Is this about
executives to put the money back into their companies, to invest in R&D, to invest in their workforce, which in turn invests in the economy?
But Donna, here's the question. I mean, and maybe we just need to separate the issues. Are we trying to raise tax dollars, which, by the way, might happen because you would discourage buybacks, you might encourage dividends, they get taxed at a different rate. Obviously, that might be what we're trying to do here. Are we trying to change behaviors? Should those things be separated? And to Jim's point, if you want capital to move efficiently to the best places for return and investment, what do you do in an environment where clearly companies, at least at the moment, don't think that they know of a place to put their money, a better place to put their money than in their own companies?
Well, so it's possible that with one policy you can do multiple things, and so I think with this policy, the idea is that if these are top 10 companies that you listed on your screen that are good companies, invest in your workforce, invest in expanding that business, and so I think that you can both, and also encouraging the kind of behavior that says that we're not going to just keep repurchasing stock, buying back stock, instead of putting it into the company and into the work.
But Donna,
I think that's a good goal.
Can I give you a complicated?
I want to give you about $125 billion.
I want to give you the most complicated example. Most complicated example is Apple. They throw off a huge amount of cash, as you know, huge amount of cash. I mean, it's mind-blowing how much cash this company has. They could, I mean, you could argue that maybe Apple should be moving their manufacturing and production to the United States or to other countries outside of China. That's something that, by the way, they may or may not have to do given what's happening with Ukraine and Russia and all of the geopolitical dynamics at play. But clearly, they can't buy other companies, by the way, given the antitrust issues in America right now. It's unclear where you'd put all that money if you were trying to put it to its best use. And maybe its best use could be inside the company.
Well, and I guess I would argue that the best use is probably inside the company, inside a really thriving company. I mean, Apple is a tough example. There are plenty of others, though, that are not investing in their manufacturing, in their domestic manufacturing, which actually could help our economy, that are not investing in their workforce, which could help our economy. So I think there are a lot of good reasons for this proposal, plus the $125 billion that it's estimated that it will raise, and then add that to what we haven't talked about yet, which is the proposal to make sure that we're taxing at a minimum 20% rate those who make over 100 or have over $100 million in income. These combined proposals would lower the deficit by about $500 billion over 10 years.
Are Apple and JP Morgan and Cisco, is the thesis here they have not invested in their workforce, that they have an undertrained, underinvested labor force? I think that's unlikely.
Jim, I would actually make the argument that a lot of these companies use stock options or restricted shares as a payment form for their employees, broad-based employees. And by the way, that's why they're buying back stock all the time, because they're issuing so much stock to do some of these things. Maybe this forces them to go back and do it in a way that's less tax advantageous.
Listen, I think that's a good point. And I think if all of a sudden we're going to be very worried.
Not that I'm in favor of it.
Pardon?
Not that I'm in favor or arguing for it, but I'm trying to look through ways that you could kind of make an argument for what they're doing, and that's about the only thing I can come up with.
Yeah, listen, I mean, I get it. I get it that some people, they don't like buybacks. They have very specific things they would like the companies to invest in. But again, what problem are we actually solving here? U.S. companies do a ton. They do a ton of R&D. All the companies that we've been mentioning obviously invest in their workforces. And so I'm sorry, what is the issue?
Jim,
what is the problem we're trying to solve?
Jim, take the tax piece out. Do you agree that executives shouldn't be allowed to sell into their own buyback programs?
Listen, I am very skeptical of plans to sort of micromanage corporate behavior in lieu of an actual problem that's having an actual adverse consequence. I understand that we're very eager to sort of signal that billionaire wealth is out of control, even though it seems to me that Elon Musk and Jeff Bezos and Bill Gates have been pretty good allocators of capital. Again, the congressman brought that up. Another example of what problem are we trying to solve? And if it's deficit reduction, then perhaps we should have spent $2 trillion on a plan that's adding several points to inflation right now.
Jim, we got to leave the conversation there. Donna, we're going to leave it there, but it's a debate that I'm sure we will continue, and we'll have you back to continue it. Thank you.
Coming up, corporate stories. Some are making headlines, and we're watching Tesla. The company says it's going to ask shareholders to vote to authorize additional shares in order to enable a stock split. Tesla watcher Dan Ives will join us to discuss. And here are the futures at this hour. You can see we've turned into green again, positive at least a little bit on a Monday. Squawk Box coming right back.
Welcome back to Squawk Box, everybody. Among the stories that are making headlines today, Shanghai is imposing fresh COVID-related restrictions in an effort to try and control an outbreak of the Omicron variant. The city will be locked down in several phases over the next 2 weeks. Shanghai is one of China's primary hubs for finance and manufacturing, and this lockdown is likely to have ripple effects around the world. We'll have much more on this story in just a few minutes, but remember, Shanghai is 25 million people. That's 3 times the size of New York City. Apple is reportedly set to scale down production of its iPhone SE. That's according to a report in Japan's Nikkei news service. The service says that Apple will cut planned production by 20% next quarter because of weaker than expected demand. And gasoline prices are still high, but they have fallen in recent weeks. The average price at the pump fell by 6 cents a gallon over the last 2 weeks, according to the latest Lundberg survey. It's not a whole lot to hang your hat on, but it does put the price at $4.37 a gallon. That's still $1.42 higher than it was a year ago. If you take a look at oil prices this morning, they're down pretty substantially, down by about 5% for WTI. And of course, that's because of the Shanghai lockdown story. Questions about demand at this point, not just supply. Squawk Box will be right back.
Now back to the news that broke in the last hour. Tesla is going to ask shareholders to vote to authorize additional shares. This is a step that will enable the stock split, which was announced but not approved by the board yet necessarily, but that should be a rubber stamp too. Joining us now on the Squawk Newsline, Dan Ives, Managing Director at Wedbush Securities. Doesn't take much to get this stock to move higher, I guess. Should this be moving the stock 4 or 5%, Dan?
Yeah, look, I think this is something that's really just the start of investors really, viewing this not just as a positive move in terms of the stock split, but also increased confidence, I think, for Tesla in their business, for the rest of the year because of Berlin as well as Austin ramping. Stock split's been kind of rumored for the last 4 or 5 months. The fact they put it out there, I think this is going to be a massive catalyst for the stock over the coming months.
Last time it did pretty well, I guess. When was that? August of 2020, and it really shouldn't, but it does. It gets more people involved, and it typically a lot of times you see the reverse happen with a reverse split. But the stock went up for other reasons back in 2020, obviously, but it was in the midst of a 5-for-1 split.
Yeah, and since then, stocks are about a 3-bagger from there, and I think what we're seeing, look, we saw with Amazon with the 20-for-1. We saw it with Apple, and I think now we'll see it again with Tesla, which will be their second stock split in a few years. But they're stronger getting stronger. And I think that's really what's happened with Tesla because of their manufacturing footprint. And there's a fundamental reason that I think the stock goes higher. But in terms of the stock split, that's also a tea leaf in terms of investors reading that their increased confidence in the business going into the rest of the year. They're not going to do a stock split if they feel like things are super negative. And I think you go back to the last one, and that was really just obviously a massive really start of what was a historic run.
Hey, Dan, I got a question for you about Elon. We're talking about COVID stuff this morning, but a totally different question. If you saw on Twitter over the weekend, he effectively said he wanted to create a new version of Twitter. If he did that, it would be his probably 3rd or now 4th company while he's the CEO of Tesla. How long do you think he's going to be the CEO of Tesla, and does it matter to you?
Well, look, I think he is single-handedly the reason Tesla is where it is, as well as with the team. I do not see him stepping down as CEO probably for at least another 5 years, because I think Musk's view is that it's really about ramping product factories around the world, getting the Cybertruck launched, and then, of course, with the Model Y ramping, ultimately, he's actually started to become more involved in the business rather than less when you think about what's happened with Berlin as well as Austin. So I think it's almost the opposite. He obviously is doing so many different strategic initiatives, but he's actually more involved rather than less. And I think that's important at a time in EV arms race.
Right. No, Dan, there's been a long debate about how long he was going to stay in that role, or whether he'd be the chairman or the chief engineer or something.
He's lonely.
Put somebody else. Oh, I saw that comment as well.
Lonely. So you just get into your work.
You get
back
into your work. Yep, without Grimes. Without Grimes. I saw that comment as well. Dan, thank you. Appreciate it. Does the audience know what we're talking about? He said in an interview recently, they may not.
I don't.
Grimes, his girlfriend,
he's lonely.
But he said in an interview recently, he said that he's lonely.
And he said he doesn't want to extend the life of anyone anymore because they become politicians.
Still to come.
He did.
Congress has failed to pass additional COVID funding after the money expired last week. We're going to talk to Dr. Scott Gottlieb on what it means for Americans next. Plus, Mohamed Al-Arian is going to join us to give us his take on markets and the trading week ahead. Stay tuned. Squawk Box coming right back. Coming up, Dr. Scott Gottlieb, plus former Council of Economic Advisors Chairman Kevin Hassett's going to join us. Talk about the possibility of a minimum tax on billionaires, blackouts for buybacks, and so much more, the state of the economy. Take a look at futures right now. The Dow looks like it will open higher this morning, about 80 points higher. NASDAQ looking to open about 45 points higher, and the S&P 500 looking to open about 13 points higher. We're coming right back from the NASDAQ market site in Times Square.
China beginning its largest and most extensive COVID lockdown in 2 years, apparently in order to conduct mass testing and try to control a new outbreak in Shanghai, a city with more than 25 million people. Eunice Yoon joins us now with more on the situation. Hi, Eunice.
Hey, Joe. Well, Shanghai's 9-day lockdown is going to be carried out in 2 phases. So from today until Friday, the east side of the city is going to be shut, and then the west side is going to be restricted until the following Tuesday. So in the lockdown areas, residents are going to be required to stay at home unless for medical or essential work. Public transport will be suspended. Non-essential companies and factories will stay closed. Now, the staged lockdown comes after Shanghai authorities had, up until this weekend, insisted that the city would not be locked down, mainly because of the city's economic importance, in order to try to minimize the cost, as had been mandated by President Xi Jinping. Officials say that Shanghai will prioritize cargo trade. The port, the airport, rail lines will stay normal. Highways will remain open with COVID tests required for those traveling out, such as drivers. The Shanghai Exchange won't be affected. City authorities say that the infections, though, just got too large scale for them to maintain their original plan, which has been this rolling 48-hour COVID tests and mini lockdowns system instead, Shanghai reported 50 new cases and 3,450 asymptomatic cases. Becky?
Eunice, I mean, the numbers are still kind of shocking. The idea that 50 new cases would lead to a shutdown of a city with 25 million people. Do we believe the numbers? Is this really what they're doing?
Well, it's difficult to say. That's one of the reasons why they're conducting this mass testing, because they say that they suspect there are a lot more infections in the population. There are a lot of questions as to what they're going to do once they detect many more people. So we've been hearing more reports about makeshift hospitals being set up, venues being cleaned out, schools getting prepared to take in a lot of those more mild cases.
Eunice, thank you. We will continue to get updates from you this week. A very concerning situation. Eunice Yoon. In the meantime, let's bring in Dr. Scott Gottlieb. He is the former FDA commissioner and a CNBC contributor who serves on the boards of both Pfizer and Illumina. And Dr. Gottlieb, hearing this, the idea of a 25 million person city being shut down at this point, I mean, it's kind of hard to get your head around at this stage in the game. What do you think of what's happening in China?
Yeah, and to your point, when they say they have 50 cases, what they report are symptomatic cases. So those 50 cases are people who presented with symptoms. They have many more cases. They don't include asymptomatic cases, and they're not including people who become infected who aren't presenting for advanced care. So you can surmise that those 50 cases are people who became so acutely ill they had to present for care and they had symptoms. So they're dramatically undercounting exactly how much infection they have. We have no idea. This is a city the size of Texas. I think they're going to have a very hard time containing this if this has, in fact, gotten out of control inside that city, and there's some indication it may have. So this was always a difficult proposition for China to maintain this zero COVID policy, and they didn't use the time that they had well. 50% of the population over the age of 65 isn't boosted, isn't vaccinated. They haven't deployed vaccines effectively among their older population. They certainly haven't boosted their older population. They've deployed vaccines that are proving to be less effective against Omicron. So I think it's going to be a very difficult circumstance there.
I had heard Eunice reporting very early this morning, talking about the idea that there is now some conversation among Chinese people in social media and other places kind of questioning the idea of why can't they have some of these Western vaccines because they think they're more effective against Omicron. Look, the Western vaccines may prevent you from getting really sick, but it doesn't stop the spread of Omicron. It just... what can they do at this point? And is this a situation where they are going to be overwhelmed because of these cases? Because, to your point, they haven't taken the time to make sure that they're better prepared for when it does come.
Well, look, someone who's received a vaccine here in the United States and has been boosted and has had a recent booster within the last 4 to 6 months, those vaccines do reduce the risk of infection and transmission. Not nearly as much as they did when we were dealing with the old variants, but they do provide some meaningful protection against the risk of infection and transmission with Omicron. So, you know, it does buy you some reduction in the risk of advanced spread. The reality is you're right. Primarily what the vaccines are providing right now is protection against severe disease and hospitalization. But as we've seen in other countries like Hong Kong, which experienced a very devastating wave with a lot of death and disease, when you don't vaccinate your elderly population, the most vulnerable people in your society, you end up having very substantial impacts from the spread of this virus. And that's, in fact, the risk that China faces right now. A lot of their elderly population has not been vaccinated, certainly hasn't been boosted. So there's a lot of risk in that population. They did have a chance to deploy the mRNA vaccines. They had licensed the Pfizer vaccine in particular from BioNTech and had a Chinese manufacturer set up to manufacture that vaccine for that market, Fosun. Right. They made a decision not to do that and not to deploy it. I don't really understand why. It's not clear why they did that. They're now working on their own mRNA vaccine, but it's not going to be ready certainly in time for this wave if they do face a wave of infection right now.
Hey, Scott, 2 quick questions. One is we're about 20 days now until the April 18th date, in which case airlines may, we'll see what happens, remove masks or not. The decision has to be made. What would you be recommending in terms of mask mandates on airplanes?
Well, yeah, you know, my view was that they should lift that that requirement on airlines. I had figured, as we had talked about, that they would extend it for a period of time and announce a date certain when that would be lifted. They seem to have backed into this mid-April deadline. Remember, that was originally up in March. They extended it for a month. I think if we're not in the thick of another wave of B2 infection in the middle of April, I think they will go ahead and lift that. I think the uncertainty around that is that we are seeing infections start to creep up. If it kind of levels off over the next couple of weeks, which it may, I think the administration will go ahead and lift that. I think if they see infections continuing to go up through April, they're going to be hard-pressed to lift that, and they'll probably kick it out another month.
And that's what you would do? I mean, not what they would do. What would you do?
I think in the setting of when infections are continuing to go up, if we're actually seeing a wave of infection, we're unclear how large it's going to be. I think it's very hard to lift it in that kind of a backdrop, and so you'd probably extend it a month. Now, that said, I'm not so sure we're going to be in that situation. You know, we do see infections going up right now, but not dramatically, and we've seen infections starting to come down in Western Europe. So it could be that this BA2 wave that we've expected could be a brief wave. It won't be a very big wave of infection. And against that backdrop, I think they can continue to lift it.
Dr. Gottlieb, thank you. Other stuff we'd like to talk to you about, but we'll have you back very soon. Thank you.
Thanks a lot.
All right, coming up, former Council of Economic Advisors Chairman Kevin Hassett on the possibility of a minimum tax on billionaires, the state of the economy, and much more. We're coming right back. CNBC's learned that the president's 2023 budget will include a new minimum tax that would largely target billionaires. It would assess a 20% minimum tax on U.S. households worth more than $100 million. If a wealthy household is paying less than 20%, they would owe a top-up payment to meet the new minimum. Join us now to discuss this and more. Kevin Hassett served as chairman of the Council of Economic Advisors under President Trump. He's now a distinguished visiting fellow at the Hoover Institution. I've said that before. I wish I was a distinguished fellow somewhere. I guess. Can I just think I'm a distinguished fellow?
No, sorry.
I can dream. I can dream. Kevin, I don't know whether this happens, and it's on income. I don't know if someone with $100 million doesn't take any current income. I don't know how it works. I guess it would be with this unrealized capital gains side of things. This is the latest, but it's not going away. I don't know whether this goes anywhere. What's your solution for getting at some of the the large gains that have never been taxed by the people that we're talking about here. Is there a way to do it that you think is more palatable or more reasonable or easier to do?
Right. Yeah, for sure. You know, the optimal tax eventually is on consumption. And if you move towards something like a sales tax or a value-added tax nationwide, then what happens is that, you know, money is either worth nothing to a rich person or worth something when they consume it. And so you can tax them when they buy a yacht or buy a car. And you can even have that tax be progressive. And there are a lot of economic models that show that such an approach is really positive for economic growth and for the economy.
You figure they can't help themselves, because if you're really cheap and if you're a real miser, that's not going to get it.
Like you.
Yeah, like me. That's
what
not going to get at it.
Then you leave money. To your kids, and then they go out and buy the yachts and stuff. And so eventually the taxpayers get their tax if you have a progressive consumption.
So you don't think anything like a wealth tax ever goes anywhere in reality? We talk about it a lot. Why do we talk about it so much? Is it just throwing a bone to the progressive left? We're trying.
Yeah, the progressive left wants to do it, but there's like a fundamental problem, right? Which is that, you know, right now, let's just say that if you put your money in long-term treasuries, you get what, 2% yield, 3% yield. That depends on whether you're going for any risk at all. But let's just say 2% yield. If you have a 2% wealth tax, then that takes all the yield. So you can say that a wealth tax of 2% is equivalent to 100% tax on capital income. And so that's really the problem, is that a tiny little wealth tax turns into a massive income tax when you think of the base as income rather than wealth. And so then as soon as you have 100% tax on something, things adjust. Income gets hit, and so on.
We've seen, obviously, the deficit coming down because you're not going to match what we spent the last couple of years during the pandemic. So that was, I don't know. It's good, and I guess you can say we're doing that and take some credit for that, but not enough for what we probably need to do. How would you close the gap? And I don't know. Republicans always want to cut spending, but that's hard to do since so much of it you can't cut, since it's non-discretionary anyway. So how would you try to raise revenue in any way other than just saying that if we cut taxes, we'll get a higher GDP?
Yeah, I a long time ago wrote a study about this with my co-author, Matt Jensen. And what we did is we looked at countries like our own now, sadly, that got their fiscal situation completely out of control, and then they tried to fix it. And then we broke them up into two groups, those that succeeded at fixing it and those that failed. And it turns out that the ones that succeeded, what they did is they put entitlements on the table. They made sort of long-run changes to their entitlement programs to grab revenue or net revenue. And they also increased taxes a little bit. But the typical successful fiscal consolidation was 80% entitlement cuts and 20% tax increases. And that's about what I think the U.S. would have to do if it wants to copy the ones who've been successful.
So, Kevin, just switching to the economy, you see the terminal rate people bandy about for where interest rates are headed, and then you see where the inflation rate currently is. Something doesn't match. Something doesn't match. Is that a new normal, or is inflation really transitory, or are interest rates going to go much higher than we think?
Well, interest rates have to go much higher than we think if we're going to control inflation. A good rule of thumb is the interest rate needs to be higher than the inflation rate if you want the inflation rate to go down. It's not like a law of science, but it's approximately true historically. And so what that means is
that's a 500% increase.
Yeah, so what it means is these little quarter point jumps that we're seeing this year are not going to tame inflation, and inflation is going to continue to be a risk to the outlook over the next few years.
Is that okay? If we don't, should we raise rates and slow it down through a recession, or do we just let it roll the dice and let it go and buy stocks because they work well with inflation? But that doesn't help people on the lower end of things, Kevin.
Right. What I would do is I would go fast and try to get it over with quickly. And the reason is exactly what you said, Joe, that, wages move a lot slower than prices. And so people have to drive to work, they have to feed the kids. All that kind of stuff is more and more expensive, and their wages aren't really adjusting, so that their real welfare is significantly worse off. And that's going to be the way it goes for a few years unless the Fed gets ahead of the curve on inflation.
Hey, Kevin, I wanted to talk about the buyback plan that Biden proposed, which is to say they're trying to limit buybacks, as you know, and incentivize more investment in R&D and the like. I imagine you don't love the buyback program, but the question is, if you don't love that, what would you do? What would you do to incentivize or disincentivize buybacks to the extent that you think that's the right decision?
Yeah, well, I don't think that focusing on buybacks is sensible at all, right? Because basically what happens is if a firm, like think of it as Apple or Microsoft, they have so much cash coming in that they don't really need to buy more machines. And the right thing for them to do is to pay a dividend or do a buyback and throw the capital back out into the capital markets where, some little startup, Joe and Kevin's coffee shop needs all the capital of the world, and we can get the capital because the buyback capital came back.
But Kevin,
so I wouldn't do anything about
Kevin,
buybacks.
most of the academic research. Kevin, though, most of the academic research suggests that when money is dividended out, it actually gets recirculated in the economy. When it gets put into a buyback, oddly enough, it doesn't in the same way.
We'd have to argue about the papers, but the fact is that you own through your index funds, which I'm sure you own, lots of companies that have had buybacks, and then what happens is that you're after the buyback, you throw your money into other equities, right? That's how it works, and so that's been the experience, the empirical experience that I've seen, and so. If as a society we have way too much capital, then at some point we have to start eating it. But I don't think that's where we are with buybacks. And I think this whole idea of going after buybacks is foolish. And that what we should do, however, is make the Trump tax cuts permanent. As you know, the expensing is expiring. And if we're a little upset about the trajectory of capital spending, then one reason why it might be heading south is that we've got. How
do you feel about executives selling into the buyback, though?
An executive who sells into a buyback is an executive, if I'm on the board, that I'm not very pleased with. That once you're doing a buyback, then you're basically returning cash to folks, and whenever there's a decision that involves pecuniary cash flows of firms, executives need to be on the sideline.
Hey, Kevin, they're not going to raise rates to where you want. Will the market take over?
Well, what'll then happen, Joe, is that we'll have inflation in the 6-7% range for a few years, right? And
that's bad.
That's not necessarily really bad. It's not necessarily really bad for markets because remember, prices move faster than wages.
It's bad for everyone.
So profits won't look.
Bad for everyone and that we supposedly care about and that Democrats care about.
Yeah, that's true.
And they say Republicans don't, but I think everybody cares about those people.
Yeah, you're right. You're right. So it's a sad 3 or 4 years, like the 70s. Yeah, it's definitely bad, which is why Chairman Hassett would be moving right now and moving much steeper.
Yeah. Where do you think? How far do you think they have the? I mean, is it feet of clay? How far do you think Jay Powell's willing to go?
I think that one of the things that we've seen over the last few years is that every time the Fed hiccups, then the market goes crazy. And the move the Fed has to make right now is pretty big. And so I don't think it's imprudent to have the first couple of moves be kind of small and cautious, just to make sure that there isn't some kind of weird new normal where the market really overreacts to every little Fed move. But then after you get a couple of quarter point moves without causing a panic, then they have to start moving at 50 basis points. And so I guess that would be my outlook, would be that we'd have a couple quarter point moves, and then we'd be looking at 50 basis points for the rest of the year.
Hey, Kevin, why should they care if the market overreacts or doesn't want them to do this? I mean, if it's what needs to be done, maybe the market's what needs to be brought along, not the Fed kowtowing to the market.
Yeah, it's a totally fair point. I think that Greenspan was the first Fed chair that started pointing to the market. But the problem is that if the market panics and all of a sudden you're looking at 10, 20% declines, then that can have an economic effect itself, and you can sort of miss the soft landing. And so I think that what the Fed people are hoping is that they can get interest rates up a little bit at a time without causing a market panic and get us to like a more sustainable trajectory without causing a recession. And frankly, if they do that, I'll be shocked. I think they won't be able to do that. I think that they're going to go too slow at the beginning. Inflation is going to continue to accelerate. It's running almost 10% right now. And then they're going to have to hit the economy with a hammer, and then the market will respond and we'll have a recession. So that's the most likely, sadly.
All right. Thanks, Kevin, former chairman of the Council of Economic Advisors, and well known to be a very distinguished fellow, just in general. Thanks.
Thanks.
It is just after 8 a.m. in New York. You are watching Squawk Box. We're live at the NASDAQ market site in Times Square. Manager Ross Sorkin along with Becky Quick and Joe Kernan. Let's show you the futures about an hour and a half before the market set to open higher. The Dow Jones about 63 points higher. NASDAQ up about 44 points higher. The S&P 500 looking to open about 10 points higher.
Let's get right over to Mike Santoli, who is focusing on the S&P 500 for his Monday morning market story. Mike, good morning.
Good morning, Becky. Yeah, same conversation is really evident in the S&P 500. Is it going to be a soft landing? What's the bond market communicating to the rest of the world? The S&P 500 also is at a very interesting spot right here. It's picked up about 60%, a little more than that of what was lost. It also kind of ends up right there where it peaked in September. That isn't necessarily always significant where we were several months ago, except if the market were to roll over from here, you're going to have people look at this chart and say, aha, that's kind of a classic top formation. As it is, it's not confirming that. In fact, the stock market has been pretty resilient. Stocks versus bonds year to date, it's been a pretty big divergence recently. We know bond values are getting crushed, yields going up. If you take a look at it, people have been talking about the possibility of a month-end, quarter-end rebalancing, just mechanical flows out of equities into bonds, just to rebalance big pension funds and other portfolios. So this gap here is why there would be the makings of that. It's just long-term bonds, not the total bond market. But nonetheless, there could be some of that, but we might be getting late. We're the 28th of the month as we are right now. But it wouldn't be too surprising for the bond move to slow down at least a little bit right here, if not take a breather and back up a little bit. A couple of areas. This would be brokerage firms and home builders that really represent some of the stressed areas of a fast-moving rise in yields, Fed tightening, lots of currency moves. Look at the Japanese yen getting crushed today. And this is a 6-month chart. The S&P over this period is up about 4.5%. So you see some underperformance on some of these risk appetite bellwether groups that you might want to keep an eye on. It has been a little bit of a late cycle leadership story. Even though the rest of the economy looks like it's doing fine, things like utilities rallying are something that people are noticing back.
Hey, Mike, you pointed out that the S&P, if it were to kind of fall back from the levels where it reached all the way going back to September, the market would be looking at that as some sort of ceiling and confirmation. What happens if the market kind of busts through those levels?
Well, it continues to kind of earn back the benefit of the doubt. I think the more it goes higher from here, especially when what's going on with the bond market, when a lot of folks are questioning whether, in fact, we can absorb the yield moves. So I don't think there's really a verdict yet until we get, let's say, above the February highs. If you really just want to look at the charts themselves, beyond that, earnings are coming. Earnings forecasts are holding up okay. We could have one of these situations where, corporate America feels like, fine, the macro has gotten people nervous, but we're okay for now.
Mike, thank you. We'll see you later in the day.
Meantime, our next guest has been telling investors to lighten up on risky assets because of the high probability of a policy mistake. Joining us right now with some more insight on the Fed, inflation, and what else investors should be doing right now is Mohammed Al-Arian. He's Allianz and Gramercy advisor and Queens College Cambridge president. Good morning to you, Mohammed. I don't want to say bizarrely, but oddly enough, you're starting to see stocks move perhaps in tandem with interest rates, or the idea that inflation is going to keep going. I'm a little surprised at what's happening here.
Oh, stocks have been incredibly resilient, and you can point to several reasons why. But the bond market is showing volatility that we have to respect. And look what's happening this morning. Higher yields at the short end. 2s, 10s is now flatter at 14 basis points. The yields on 3s, 5s, and 7 is higher than the yield on 10-year bonds. And all that is telling you that the bond market believes inflation is too high, the Fed is well behind the curve, and the Fed risks, as we heard, pushing the economy into recession as it tries to catch up.
And are you surprised, though, that the stock market has held up, given what you've been saying for the past couple months?
Surprised, no, but wary. Now, why am I not surprised? The initial conditions are very favorable. even though financial conditions have tightened, they are still loose in historical terms, in absolute terms. Secondly, the consumer and the labor market is still supporting the economy. And third, as I said to you before, where do you go? Do you go to cash where you're guaranteed a -8% real return? Do you go to bonds that are getting hammered? Where do you go? So investors look around and say, you know what, stocks may be the best place to be for now. It just needs to continue to withstand considerable macroeconomic volatility, rates volatility, and currency volatility. That's what the stock market is navigating right now.
Hey, Mohammed, will you weigh in on this Biden proposal around trying to limit or disincentivize buybacks? We were talking earlier just about how big of the market these days is supported by buybacks across the board, $238 billion just this year so far. This is a number that may hit $1 trillion by the end of the year. Does that make sense to you? And what do you think should happen?
So it's complicated, Andrew, and the conversation you've had all morning tells you why. Look, on the one hand, if companies generate excess cash and if they believe that the best use of their cash is to have buybacks, you've got to respect that. But you've got to ask the question, why is it that we are in this situation? I think at the end of the day, this is about much broader issues, and whatever you tinker to try to change incentives is not going to matter that much.
When you look at the price of energy over the next, say, 6 months, and then you start to think about the true ramifications of that, and also some of the more geopolitical issues in terms of companies having to rethink where they're going to be putting their manufacturing capabilities, do you think that's going to ultimately eat into margins? That's a conversation that I've been thinking a lot about, but I don't think is sort of in the air yet, and maybe for good reason.
You used ultimately, and ultimately is the important word here. The corporate sector has pricing power. It has pricing power because demand is still solid. So we'll be able to pass through the higher costs. Look, we are looking at a cost of living crisis. That's what we're looking at for the next 2 quarters, 3 quarters, where the average consumer is going to be hit hard by inflation, is going to get hit hard by lower consumer sentiment. The good news, if there is good news, is you're seeing how the oil market is reacting. For the first time in a long time, demand is now the price setter, not supply. People are worried about the China lockdown. People are worried about consumer sentiment. But overall, we are going to go through a difficult period where the cost of living is going to be on everybody's mind.
Hey, Mohammed, just going back to this billionaire tax, just what it would get at. Somebody points out to me, somebody who has been an entrepreneur and has done this. Look, if you have a founder who has raised money, who owns a big portion of something that they've created, maybe 10%, if they want to raise money, if the company's still private, if they do that at a higher valuation, then they're going to be owing a big tax bill on these unrealized gains. It could be a founder who doesn't have a lot of money. It could actually change the way people do things in this country and really have a huge impact on entrepreneurship. And that is one way of looking at it, this idea of killing the goose that laid the golden egg. Do you have concerns about that? Would that be something that you would point out to the administration before they move ahead with this?
I would point out that that is one of the unintended consequences. Look, they're trying to close loopholes that have existed for a long time, and they haven't been able to close them directly. They're trying to have a more progressive tax system, and they're trying to raise revenue at a time when they're going to have to step up and try to protect the most vulnerable segments of the population. So it's very difficult to solve all this with a single instrument, and that's why you get all these unintended implications. So we all go back to what we really need is fundamental tax reform. We've tried it over and over again. There simply isn't the political will to get it done.
Great. If you started with something that maybe was less contentious, I mean, I just think the idea of getting at unrealized gains is almost a non-starter. I don't know how you do that. It seems like it's a little crazy. If you wanted to do something like tax a minimum of 20% on all realized gains, you know, that's a different story. But once you start getting at the idea of unrealized gains, that is a mess. It opens up all kinds of crazy unintended consequences.
Yes, because a lot of people, especially the founders you talked about, are asset rich and cash poor. So when you suddenly go after unrealized gains, you hit immediately that contrast between assets and cash.
It just doesn't recognize that there are bubbles that will exist in markets and valuations and all kinds of things. And the idea of paying on that when it's monopoly money, it's not real money.
But the conundrum is when you go after the things that actually, I would argue, make more sense, whether it be carried interest or death of taxes.
Those don't make sense to me.
Which may make sense to you, by the way, don't make sense to everybody. There's a whole other group who won't even vote on that.
But that is something that I think you can have a logical conversation about.
But for reasons that are inexplicable, we have not been able to have a logical conversation. You and I have had a logical conversation about it. Others in Washington haven't. Now, I don't, it's just the way it is. So then the question is, what do you do about it? Mohammed, it's a longer conversation. We love seeing you. Hope to see you again very soon. Thank you.
Thank you.
When we come back, the Oscars making headlines last night with a big night for the big streamers and some big drama, too. We'll get you up to speed on the action out of Hollywood next. And as we head to a break right now, let's take a quick check on crypto prices. Bitcoin this morning up 5.5%, above $47,000. Stay tuned. You're watching Squawk Box, and this is CNBC. Welcome back to Squawk Box right here on CNBC. Here are some of the stories investors are going to be talking about today. First up, Apple will reportedly cut planned iPhone SE output by about 20% next year. That's according to a report by Japan's Nikkei news service citing weaker than expected demand. Apple shares this morning down by about 1.33%. Tesla shareholders are going to be, Tesla will be asking shareholders to authorize the issuance of additional shares of stock at its upcoming annual meeting. That's according to a company tweet. The additional shares would allow Tesla to split its stock, and that could make it more attractive to a wider array of investors. Tesla shares up by 6.1%. And Adam Aron, the CEO of movie theater chain AMC, telling Reuters his company will strike what he calls a transformational deal, or many transformational deals. That follows AMC's roughly $28 million investment in gold and silver mine operator Hycroft Mining earlier this month. Yeah, that was a weird one. Stock's up by about 1.5%. Don't miss a live interview with Adam Aron next hour on Squawk on the Street.
It won't be a film company when it's over, or a theater company. It'll be something very different.
Merge with GameStop.
Coming up, President Biden about to target billionaires with a new minimum tax. We're going to talk about it and break it down. But the pairing you don't want to miss, Skybridge capitalist Anthony Scaramucci and venture capitalist Kevin O'Leary debating it all. But next, we have a different drama, this one at the Oscars, and it has nothing to do with Best Picture. A wrap-up of Hollywood's big night, including what it all means for streaming and wrestling. Next, you're watching Squawk on CNBC. Welcome back to Squawk Box this morning. Take a look at futures right now. We are in the green across the board, about 43 points higher on the Dow. The NASDAQ up about 33 points. The S&P 500 up about 7 points. And a new COVID lockdown taking place in Shanghai amid some demand fears, putting pressure on crude oil this morning. Take a look at where we are. WTI crude at $107, $108 right now, off about 5%. Meantime, the Oscars, Joe.
Returning yet to a normal telecast. That was normal for the first time in 2 years. But last night, as we just alluded to, ended up anything but normal. Julia Borston joins us now with more. Hi, Julia.
Well, Joe, it was a very unusual night with some very surprising celebrity drama that I'll get into. But movie star surprises aside, it was a landmark night for the entertainment industry as a streamer won Best Picture for the first time ever. Now, Apple TV Plus's Coda won not only Best Picture, but also a Best Adapted Screenplay and Best Supporting Actor. This is particularly meaningful in terms of a win for CEO Tim Cook and Eddie Q, who oversees Apple's content business. because it's been just 3 years since Apple announced its streaming service and 2.5 years since Apple TV Plus launched. Now, it's also a bit of a disappointment for Netflix, which had the most nominees of any studio, 27 going into the awards, and it spent many more years than Apple, pouring tens of millions of dollars into Oscar bait films. Now, it again garnered just one award, and that was Best Director for Jane Campion, pretty much as expected. Now, of all the studios, Warner Brothers actually won the most statuettes, 7, which was driven by Dune, which had 6 awards. Disney drew 6 awards total and in second most place, and then Apple was third in terms of the studios with those 3 awards. Now, one of Warner Brothers' awards was Best Actor to Will Smith. That was a win that was overshadowed by Smith unexpectedly walking onto stage and slapping presenter Chris Rock. He was outraged over a joke that Rock had made. Smith then called him names that were bleeped on TV. This whole exchange sent the room into a hush. I was there in the room. It was really surprising. Smith then, when he won, went on stage to make his speech. He apologized to the Academy in his speech. He did not apologize specifically to Chris Rock. But what a weird night, Joe.
You know, immediately, was it staged? That was a headline, and other people saying he put his chin out there for it and kind of pulled back. We know about publicity. There's no publicity. I guess it's necessarily bad. You remember Justin Timberlake, and I think that was totally staged. This is not. This looked like absolutely impromptu, and it just happened. Temper, right?
I have to say that is how it felt in the room. I mean, the Oscars is so perfectly produced down to the second. They have seat fillers standing by. Everyone in that, especially in that orchestra level of the Dolby Theater, is totally coordinated, and this was really a surprise. I mean, by the way, when they have people in the audience speak, they're mic'd up, and you heard Will Smith just yelling, not mic'd, but it was picked up by some of the other mics in the room.
It's so perfectly coordinated, like when they announced the Best Picture, nothing could ever go wrong with that, right? Because it's so perfectly.
Look. The only other time. Yeah, the only other time I've seen anything like this, I've gone to the Oscars, been lucky to go to the Oscars many times, was that time when they accidentally announced La La Land as the winner of Best Picture instead of Moonlight. But this was a very weird moment, and when you saw the publicist run in to go talk to Will Smith, you just knew that this was not a planned thing.
Yeah. It's, you know, there have been things. I remember Brando and George C. Scott. And you remember Rob Lowe and Lucille Ball? And he was serenading her, right, and doing a dance with Snow White. And Anna, you remember that? That was so that was different, though.
I do remember that dance, yeah.
That was cringeworthy.
Julia, were people upset, though, with Will after? Because he looked like he was at these parties afterwards, you know, having a ball.
Well, you know, there was a lot of discussion about whether or not the speech he made redeemed him. I mean, the speech felt like a very thoughtful speech, and the question is, did he apologize enough? But I think a lot of people were impressed by that speech.
All right, Julia, thank you. Julia Borstel.
I just realized why we're not talking about Ukraine anymore. It's been washed off.
That's the problem.
By something.
Yeah, that's the problem. Yeah.
Anyway, when we come back, are we in a new era for unions? We'll take stock of the shifting worker landscape at companies like Starbucks and Amazon, and we'll talk about what it means for investors too. Then former White House Communications Director Anthony Scaramucci and VC Kevin O'Leary sounding off on a new billionaires tax from the White House. Wonder which one of them is going to be defending this. Stay tuned. You're watching Squawk Box, and this is CNBC. After the resignations and worker reassessments of the pandemic, it appears that we are entering a new phase for employees' organization. In fact, just today, the National Labor Relations Board is beginning to count ballots from the second unionization vote at a key Amazon warehouse in Alabama. Kate Rogers joins us right now with more on union membership rates and what got workers to this point. Kate, good morning.
Becky, good morning. Good to see you. High-profile union drives and strikes are underway at a handful of companies, from Amazon to Starbucks and REI, with workers deciding to use their power to push for better pay and working conditions. Some workers I've spoken to seem keen to improve things for themselves and their coworkers for years to come by organizing and collectively bargaining, even if they don't stay in these jobs forever.
Regardless of where my personal journey takes me, I am still absolutely committed to the union drive so that these benefits can be put in place and established, and a legal contract can be established to have in writing clear and concise outlines and boundaries of what this job entails and what benefits we deserve.
And while it may seem like union membership rates are higher than they've been due to some of these campaigns, BLS data tell a different story. In 2021, the union membership rate overall was 10.3%. That's down from 10.8% in 2020, which was due in part to a big decrease in non-union workers tied to the pandemic. In the public sector, the rate is 5 times higher than the private sector at 33.9% versus 6.1%. Now, the challenge is twofold for private sector and retail and restaurants in particular. Workers tend not to stay in these jobs long enough to see some of these fights and contract negotiations through, and getting an actual contract can be a challenge, as companies do have to bargain in good faith with the union, but agreeing to it is a different story. Becky?
Kate, what does all of this wind up meaning for public companies like Starbucks and Amazon as the union fights play out very publicly? That's why people think union membership is up, because of how public these fights have been.
These certainly have been very public, Becky, and they're really doing a delicate dance here, right? Because you don't want to be seen as very aggressively anti-union campaigning, right, with your workers and kind of meddling in the election. And that's kind of what led us to getting a second vote here at this Bessemer warehouse in Alabama. But investors are also wondering, is this going to be more expensive for the company? How much money, how much time and resources and energy are they going to put in each one of these fights? Look at a Starbucks, which is facing many more stores seeking to organize than these Amazon warehouses. They've got more than 150 stores that have now petitioned the NLRB. That's out of about 9,000 locations across the U.S., but the numbers go up. Investors certainly have to be watching and wondering what the cost is here, too.
That's the return of Howard Schultz. Kate, thank you.
Thank you.
All right, joining us now, with the president's new moves in mind, President Biden, if you don't know, expected to target the nation's wealthiest when he releases his 2023 budget. The billionaire minimum income tax would hit households worth more than $100 million. With a 20% minimum tax rate, over half the revenue could come from those worth more than $1 billion. Joining us now to talk about this idea, Anthony Scaramucci, Skybridge Capital founder, co-managing partner, and a CNBC contributor. And Anthony, I checked, I had to do a little work. I'm fine. This is not going to, from what I can tell, this is not going to, I don't know how to value everything I have, but I think
maybe
I'm okay.
Next year, Joe.
Yeah, maybe not. I'm not so sure.
I mean, look at the inflation rate. I mean, maybe next year,
Yeah, how about
I gotta check with your agent, Joe.
O'Leary, we're both about in the same age. I guess you had to leave for a second to do, we don't even want to know, Kevin, but oh no, you're outside. You made it back. It's good to see you. You guys, I don't think, this is going to be a crappy debate. Do either one of you think this is a good idea? Anthony, you start first.
So, Kevin's probably more of a staunch capitalist than me, but I think this is one of the more terrible ideas to come out of the Biden administration. And I think this is just more left-leaning, lurching to the left. If you're taxing accumulated capital, that's going to just have disastrous consequences. It's totally a disincentive for people to form capital and takes the risks necessary to create all this prosperity and innovation. So there are so many different ways that they could come up with paying for these deficits, and there's so many different ways that they can go after the billionaire class without taking their assets. This is basically just a wealth tax. And I think Kevin actually agrees with me on this thing. I thought we were going to debate the unions, which I'm happy to do because my dad was in a union.
Kevin, you go ahead, Kevin. What's your take?
Without getting into politics or bashing Biden or, what's being attempted here, let's ask ourselves a question about policy. And simply this. If you take the 400 people this is really going to affect, they're some of the most extraordinary individuals that have ever created businesses in America. Elon Musk and Amazon outcome and everything else. There's thousands and thousands of jobs have been created, billions in taxes have been paid. But here's the fundamental issue. If you want to take Elon Musk's money from him while he's alive, because remember, we're getting it from when he's dead. The estate tax is going to clean him out when he's dead. But why take his money now when he's creating all these jobs and all this innovation? Maybe you like him, maybe you don't like him, but the facts are this. He took the excess capital from creating a brand new industry in electric cars and went into space in a way that the government never could. He beat them at their own game. We need people like that. This is un-American, this idea. It's fundamentally against 60% of the economy, where the companies I fund, the men and women who create family businesses, are vehemently opposed to this, regardless of what side of the aisle they're on.
Hey, Kevin, I'm with you on this, but then you said we'll take it to death. The truth is we won't. So if you're happy to support an estate tax, a meaningful estate tax, we can have this conversation. Also, would you think about those who effectively take loans against their stock? At some point, you could decide those loans represent the equivalent of a sale. Perhaps at that point, there should be some kind of a tax taking place. I mean, there should be some wiggle room.
Those
Carried
loans
interest,
are
for example.
not a sale. No. Let's go back to the loans, okay? They are fully at risk. If Elon Musk wants to borrow against his stock and it collapses for whatever reason, and there's many times in the stock market and in history where great companies hit a road bump and the stock gets cut in half. AMC, if you borrowed money against that, you would have a margin call and you'd be wiped out. He's taking huge risks. But that is not good policy. This idea is
Kevin, you do realize that there are a lot of people who have made an enormous amount of money who effectively then take loans out against their stock in perpetuity until death, so that actually, and then by, of course, give so much money away, and I'm all for giving money away, as you know, but that it never gets taxed by the system, so that you and I effectively subsidize them.
I'm good with it, Andrew. I love entrepreneurship. I'm good with the jobs created by Elon Musk and the tax he's paid. I mean, he's the poster boy for this nightmarish policy. My point is, this is not what created America. This is not why I came as an immigrant to America. I wanted a big market, access to capital, and to create a business. I was very fortunate, and I've paid a lot of money in taxes, and I'm okay with it. But this is attacking them for their success. It's un-American. That's what it is. And I predict this, not that I want to get into politics, Biden is going to get decimated in the midterms. Even his own party, the entrepreneurs in his own party, and I've talked to 30 plus of my CEOs, think this idea is insane, really bad, and un-American. So let's call it what it is.
How do you want to do it, Anthony? You were nodding that maybe.
Well, listen, Kevin's doing a great job, so I don't want to interrupt him, but I would tax the interest on those loans. Kevin knows that when you take out a margin loan, you get an interest rate deduction on that loan. I think that that's unfair. So if someone's taking out a $100 million loan on $1 billion worth of stock, I don't think they need the tax deduction there. That's one way to get savings back. There should be, like there's an alternative minimum tax. There should be an alternative minimum estate tax. I think Kevin's point is you're going to tax them at the end, and Andrew's saying, well, no, because they figure out a way to squirm out of that. But that's how you can get it. And I think many of those billionaires that are already giving, and they have a giving pledge set up, I think would probably be okay with that as well. But taking the capital, I'm sorry.
I was just going to actually pivot and say, where do you guys land on disincentivizing buybacks by effectively creating these blackout periods for executives so that they would have to wait several years to sell into or sell after a buyback as opposed to sell into a buyback?
That's manipulating the market. It's a very bad idea. Listen, buybacks
Which is
are what they
manipulating
are.
the market, Kevin. Some people think that the buyback is a manipulation or self-dealing in the market because the executives then sell into it, and the studies suggest that they're doing it at 5 times the amount typically would be done otherwise. You're saying it wouldn't be manipulating the market in a different way.
You know, you can decide as a shareholder if you agree with buyback programs or not. You have the full liquidity. You get the transparency. You decide if you like it or not. I personally don't like buybacks, but I understand why companies do them. There is some form of tax contortion. At the end of the day, though, you should let it be transparent, let individual shareholders decide. The last thing you want is the government deciding liquidity in public markets. This is more bad policy. All of this stuff makes no sense whatsoever. And I think at the end of the day, if I were Biden and not telling what to do, I'd start worrying about inflation on food and energy costs right now and forget about all this tax stuff. He's never going to get this through. And when the midterm's over, which is just months away, he's going to have zero ability to drive policy. So right now I'd focus on what matters to help the rest of his party. And I'm not trying to be partisan here. I'm just saying this is not what Americans care about right now. They care about the price of gasoline and the price of protein. This is not high on their minds. And the entrepreneurs out there that are creating jobs in this country and they're working hard as hell in families think this idea is really, really bad.
So I just, again, I heard your debate this morning or your discussion this morning, Andrew. There should be a ratio test. You have to look at what the CEO did over the prior quarters. And then if he's going to initiate a share buyback, he should be capped at a certain number. So it doesn't look like he's selling into that buyback and incentivizing himself to trigger capital gains for himself or herself. And so I think those things are very solvable. I think at the end of the day, both Kevin and I are not looking for left or right policy, but just right or wrong policy. And that would be a very fair policy. And that would take the pressure off the CEO as well, where he won't be accused of doing things that are nefarious.
Kevin, you want to just wrap things? I'm looking at that shot of you, Kevin. There are a couple of jet streams going out of both sides of your head. It almost looks like when you speak, it's like, oh. I mean, this is. Did
or
you
steam coming out of it?
Yeah, or steam coming out of you.
It's a live shot of vineyards. I'm in the wine business. The grapes are sleeping. It's a very important time. The new vines are coming. This is a wonderful time in Switzerland right now where I am, and I'll be joining the mooch in a few hours. I'm flying to Dubai. And we're all going there. Why? Because that's where the money is. And I think it's going to be a great few days. But at the end of the day,
I finally got ahead of you on something.
Yeah, that's
I'm already
true.
here, Kev.
But I'll see you tonight, my friend. I'll see you there. But my final thoughts on this are policy is all that matters, and sometimes you get it right and sometimes you get it wrong. The essence of the American dream is entrepreneurship. Everybody that starts a business wants to be Elon Musk one day, and some of them make it. And on the way, they create tremendous wealth for themselves and all of their employees, and they solve huge problems for society. Why are we punishing them for that? Why would we even contemplate policy like that? This is, again, I'll say it one more time, un-American. Let's forget about this. It's a really bad idea.
The one thing you're leaving out, though, Kev, is we have to close this wealth gap. If you go back 50 years, the rich were not this rich relative to the middle and lower class. These are dumb policies to do it. There's better ways to do it through infrastructure spending, jobs training, education. There's a ton of different ways to do it. I think you and I are both for unequal outcomes pursuant to meritocracy and your innovation and risk-taking. But we need to create a platform of equal opportunity for people because we didn't choose our places of birth. We didn't choose our parents. And we need to give these people that are born disadvantaged an opportunity. And so we're smart enough to come up with that, and we have to start thinking like that.
Mooch, the best way to help those people is have a roaring economy full of entrepreneurs creating wealth for everybody. I mean, that's just what works in America. And every time you try and redistribute wealth, you come up with ideas like this, which are just plain really bad.
All right, very good.
We agree on that.
Yep. All right, Anthony. Thanks, Anthony Scaramucci. Kevin O'Leary. He was nice. He's a nice guy. Thanks.
When we come back, a lot more challenges for big tech or a step in the right direction. We're going to ask top venture capitalist Bradley Tusk about the FANG impact on the EU's new Digital Markets Act. And a programming note, don't miss the CEO of HP on Squawk on the Street this morning, talking about his company's acquisition of communications tech firm Poly. Stay tuned. Squawk coming right back after this.
Under an hour now until the opening bell on Wall Street, and Dom Chu rejoins us with a look at some of this morning's top pre-market movers. Hey, Dom.
I'm glad we haven't forgotten about the 7 a.m. movers that we did earlier in the second hour of Squawk. Thank you very much, Joe. So first of all, let's talk about what's happening right now with the Merger Monday deal, if you will, of the morning so far. That is HP Inc., the consumer electronics giant that does a lot of things with regard to computer hardware. HP is going to buy Poly, which is the legacy company of Polycom, conferencing, video conferencing, and voice conferencing software, and Plantronics. Those companies together are now Poly. It's up 50% in the pre-market trade right now because HP will pay $40 a share in cash for Poly. It's about a $3.3 billion enterprise value deal, so that's equity plus the assumption of debt overall. So that's the reason why you're seeing that. And by the way, what's behind the deal? Well, take a look, because on a big interview coming up later on Squawk on the Street, HP's CEO Enrique Lores will be on to talk a little bit more about what's driving that particular deal to acquire what is in essence Plantronics and Polycom together. A big deal there, a CNBC exclusive. Pay attention at 9:40 a.m. Eastern Time. Also, watching what's happening now with shares of Beyond Meat, because Beyond Meat's down about 6.5% in the pre-market trade, a little pickup in pre-market volume. This is driven in large part by a downgrade by an analyst over at Piper Sandler. They now say this is an underweight or sell equivalent stock. It was a neutral before. They cut the target price to $29 from a prior $50. They think that some of the growth expectations should be more tempered in the coming weeks and months, especially with some of the McDonald's rollout perhaps not meeting some of their expectations for the pop that it would have gotten. So Beyond Meat shares are down on that particular downgrade, or at least being driven in large part by it. And then a check on the most popular tickers searched on our website, CNBC.com, from Friday's full session. Maybe no surprise, the 10-year note yield remains number one, but number two, crude oil, jumps back up to the number two spot, despite the fact that we are now down 5%. A lot of attention being paid there. Marijuana companies, and Tilray in particular, down 5.5%. Still a lot of interest there. Tesla, Apple, NIO, the EV makers, very much in focus there. By the way, Apple is riding a 9-day winning streak entering today's trade, even though it's down in the pre-market trade right now. Joe, as always, the rest of the top 10, highlights from the top 50 on my Twitter feed at Domino. I'll send things back over to you.
You know what Friday is, right?
What's Friday? Jobs Friday, or what kind of Friday are we talking about?
Jobs Friday.
Yeah.
That means it's April. And you know what April means, right?
Showers, Mayflowers, something like that.
Masters,
I know. Azaleas and everything
and
else.
Flowers,
yes.
As you said. Yeah. So just we got that going for us.
We're going to talk a lot more about that, I'm sure, in the coming weeks.
Maybe. I got women's Final Four to think about tonight.
And your $5 bets, I know.
And yeah. Coming up, Jim Cramer's first take. I parlay him, too. But first take on the trading day ahead. Squawk Box will be right back.
get down to the New York Stock Exchange, where Jim Cramer joins us now. I know you got the CEO of HP on Poly in just a moment. You a fan of the deal?
Well, you know, I do like anything that makes it so it's a larger suite. At the same time, I've got to tell you, Andrew, there's a lot of companies who do this, and the kind of way that they're talking about is they're putting it as a hybrid workplace, which I would say, well, then, you know, so is Logitech a hybrid workplace. There's a lot of different ways to kind of put the deal, but I think that the ultimate hybrid workplace, we'll have to talk to Enrique, is to me overdone. I mean,
what do you think about incentivizing, or in this case, disincentivizing? This is the Biden administration this morning, the idea of buybacks through a 1% tax, but perhaps more importantly or interestingly, this idea of creating a blackout period for executives so that they can't effectively sell into a buyback.
Well, there are only a few periods where they really can sell, and most of them do not sell into a buyback. They have a window, they open the window. I think it should be more specific and less judgmental. Like an individual company they should all be told, look, you can sell in the first 5 days. And start the buyback on day 6. That makes sense to me. As far as the individual tax, I think that's a non-starter. Won't happen. No more than I think that this $100 billion, whatever, over 100 million. That's not going to happen.
Jim, but the truth is they do sell into the buyback at materially larger numbers than CEOs that aren't pursuing buybacks.
Oh no, I agree. I mean, they should have a window where they can sell, and then the buyback starts. I agree with that.
You're saying prior to a buyback?
Yes.
Right.
So you sell in the first 5 days after your report, because then everybody knows the same thing. And then you can start the buyback, but you can't sell into the buyback. That's how I did it when I was at the street. You can't sell into the buyback, for heaven's sake, because I was handling the buyback. I can't sell it. I can't sell the buyback.
Jim Cramer, we will see you in just a couple of minutes. Squawk, coming right back.
Gotcha.
The EU late last week striking a deal on what's called the Digital Markets Act, and it could have some huge implications for America's tech giants. The so-called gatekeepers like Apple, Amazon, Meta, and Google could see their market power curbed through rules against giving their own services preference over other companies. Joining us right now to weigh in on the legislation and what it could mean for established tech companies and for startups is tech investor Bradley Tusk. He's the CEO of Tusk Ventures. And Bradley, how do you feel about these rules?
Look, personally, I think they're a good thing. I understand why Apple and Amazon and everyone else doesn't want them. But as an early stage tech investor, it is virtually impossible right now for me to invest in a company that's going to compete with Microsoft or Google or Apple or Amazon or anyone else, because they have so much power in the marketplace that they can just crush them immediately. So I think from the perspective of wanting more innovation and wanting more competition, this should help. And I just don't think monopolies are ever particularly good for it.
I mean, obviously, you've got some skin in the game on this, too. You're looking for startup companies. You think that startup companies are hurt pretty badly by this. Competition is hindered.
Yeah, I mean, I do. I mean, I think right now, at least in the U.S., there are virtually no rules limiting the ability of platforms to favor themselves at the expense of everyone else. What the Digital Markets Act attempts to do is to say, look, just because you're on one platform doesn't now mean that you've given up your rights to privacy. It doesn't mean they can monetize your data however they want. And most importantly, the act allows for data portability and interoperability, which means you can go from one platform to another and still have everything preserved and have all of your data and not have to recreate everything every single time. This is especially important as we start heading into the metaverse, where we're going to spend, so much more time as our avatars. And the more that we're able to go from metaverse to metaverse without having to redo everything every time, the better it is for consumers.
There have been rules that have been similarly floated in the United States. You think they pick up traction if this is something that they're looking across the pond and thinking yes?
I think one thing Americans all have in common is we don't really care what the EU does about much of anything. I don't, but I do think that you've seen some movement in Congress. There was legislation that passed out of the Senate Judiciary Committee a couple months ago that was bipartisan. It does seem like one issue that unites both parties and the left and the right is sort of at least a general, a hatred for Facebook at the very least, if not the other platforms too. And so politically, it is feasible. I think the biggest one would be something called the repeal of Section 230. That currently makes it so that platforms like Facebook or Twitter are not liable for the content that's posted on the platform. The EU is looking to repeal that through something called the Digital Services Act. If the U.S. did it and Biden could potentially do some of it through executive action, that would really change things.
So what about this news this morning, the idea that the Biden administration is going to be looking to tax unrealized gains on anybody who has more than $100 million in wealth? I would assume that would have a pretty big impact in your world.
Yeah, for sure. I mean, look, I live and work in Manhattan, and the idea came up in Albany with the state legislature. And my view was, if they were to pass a tax on realized gains, we would have to leave New York, because by definition, as a venture capitalist, I've got a handful of investments that go from a very small valuation to a very high valuation, but they're not liquid, so I can't pay taxes on them. And then a bunch that go to zero. That's how VC works. Taxes on unrealized gains, to me, are the best way to drive business out of your city, state, or country.
Okay, so if you were going to leave New York State, does that mean you would leave the United States if this is passed as a federal law?
I mean, no, because luckily I'm not a billionaire yet, so it's not my problem at the moment.
100 million. It's a tax on anybody who's got 100 million in valuations.
Yeah, look, it's a good question, right? I mean, I think when he worked for Mike Bloomberg when he was mayor of New York, he always argued that he didn't want local tax increases because that sent jobs out of New York City. But his view was, if it was a national tax increase, people are much less likely to leave the country altogether. So I think I would face the same challenge as everyone else. Yeah, I understand why Biden wants to do it. Maybe it kind of opens the door to Manchin again on the Build Back Better bill. Certainly plays well with progressives. The Biden White House seems exceptionally concerned about what progressives think about everything. And so I get it, but I do think it's a troublesome idea.
Bradley, thanks for your thoughts this morning.
Thank you for having me.
Bradley Tusk. All right, folks, that does it for us this morning. We're looking at things this morning with markets at this point a little bit higher. At least we've been watching the Dow higher through the morning, and we'll continue to see this. That does it for us today. We will see you back here tomorrow. Have a great Monday. Right now it's time for Squawk on the Street.
Good Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer. David Faber is back. Futures are steady as the bulls try for a third week of gains, something we've not strung together since last fall. Shanghai's lockdowns in focus, oil's down, more curve inversions ahead of a bunch of data this week, ISM, auto sales, and a jobs number. Our roadmap begins with the Tesla surge, though. Shares are popping ahead of the open as the EV maker announces plans to split a stock.
Plus, Apple's demand perhaps waning. The Nikkei reporting the company plans to cut output for its iPhone SE by 20% next quarter. And it is a Monday. We do have some deal news, not a lot, but HP buying the workplace communications company Poly. CEO Enrique Lore is going to join us later this hour. By the way, AMC vowing more, quote, transformational deals to come. Its CEO Adam Aron also joining us in just a few minutes, Carl.
We'll start, guys, with Tesla, though. In this SEC filing, the company discloses it will ask shareholders to vote at this year's annual meeting to authorize additional shares in order to enable a split. Comes almost 2 years after Tesla enacted that 5-for-1. Whispers, Jim, of dividend motivations here. What do we think?
Well, look, I think that we're all trying to figure out and gauge the level of excitement about the market, and whether it's been quelled, whether there's still people who buy on dip, whether there's still a lot of retail. We'll have Adam Aron on talk about the apes in retail. This shows me that perhaps there's too much enthusiasm versus what we're seeing from, say, the Mike Wilsons of the world, once again saying that bonds are sending the wrong message. I don't want to see Tesla go up on split. Obviously, I want to see it go up on, I would say, on production. And yet the Shanghai news indicates that production is maybe down in China. So, David, you know, you get the enthusiasm about a split, but you don't necessarily get a ramp up of production. Maybe that's not as significant, the split not as significant as the production.
Yeah, and that production coming as a result of the lockdowns in Shanghai,
Yes.
which are incredibly large, half of the city at one time and then the other half the next, as they try to deal with a COVID outbreak. They're still having the zero tolerance policy in China, which many, of course, pretty much the rest of the world has given up on any hope of
Even
that.
Hawaii.
Even Hawaii finally gave in on their mask protocols inside.
I don't know. I'm concerned about what kind of vaccination process they have in China that you would have such a severe lockdown. Because here, you know, people just accept. I mean, we get famous people getting COVID every day. It's like kind of like, oh, really? Okay, so COVID. All right, she got COVID. He got COVID. I mean, and there it seems like that to try to stem it would seem to be like putting fingers in a dike. I don't know how you do it.
It is their biggest lockdown in a couple of years. As David said, they'll do half of the city. I heard some reports this morning. B of A's note talks about traders with sleeping bags so they can stay at work and keep operations going. Is that why oil's down 5%?
Yeah, I mean, people just think that it's suddenly demand is not where it should be. I got to tell you, I get production numbers from Rusty Brazil from RBN. Production's not up. I mean, I think that you have to buy oil on weakness every time. I buy it on weakness. I buy Chevron at 166.
Why?
Well, because I don't think that China necessarily correlates with worldwide demand, but supply has simply not increased at all. And by the way, what happened to the idea of maybe Russian supply coming on?
Well, we did have a couple scary, I guess, nervous headlines. One is that the Germans say we're not paying for your gas in rubles. And then Russia replying a few moments ago on the tape, at least, saying, well, that might spark a halt of your supply.
Then oil goes through the roof?
Potentially. There's also the question as to what Russian productivity is going to look like 6 months out. I don't know how much focus this has gotten, but, you know, for example, Sakhalin and other parts of their oil complex that have been run in part by large multinationals.
Right. I mean, whether they can maintain production?
Can they maintain
without
production?
Schlumberger technology?
Correct.
It's not clear.
Does it become more like what we saw Venezuela become in terms of the significant cuts in production once they nationalized so much of their oil, or they nationalized their oil business, so to speak, and all the multinationals pulled out? I mean, it's not clear the Russians have the technological prowess to actually be able to continue at the same levels that they were.
Well, you're absolutely right. I mean, the kind of technology that it takes to get more out of a well is all American technology. And I know Schlumberger is more of an international company, but it's absolutely true that you cannot do as well without these great service companies that are American technology.
Yeah, and then remember Exxon, obviously, and some of its partners who have pulled out of Sakhalin, which is not an unimportant component of production there. So that's over time, but not that much time. You know, that could be 3 to 6 months. You could see a reduction in the actual production out of Russia. Not to mention the continued question as to what's going to be purchased or not, and how much on the open market and at discounts.
Hence, that's why I want to buy Chevron 165, because I just see it's the production side that's in trouble. And
more than demand.
Yes,
more than
in the United States, I go back over to all these different producers, and they reiterate, Jim, you keep expecting us to break discipline. We're not breaking discipline, except for the private equity players, David, who are still have to pump in order to be able to come public or get a bid.
Right, or actually just generate a lot of cash flow.
They need cash flow.
Yeah.
Baker Hughes, rig count's been inching up. I mean, does that mean anything?
It's still private companies. The big guns are represented by Devon, with Rick Muncrief, the CEO, just says, look, what are we going to ramp up now? The forward curve shows that oil will be lower a year from now. So we'll end up spending our money unwisely and people will sell our stocks. So, Devon's another one that I think is great. I think these companies they've really got religion about being reckless. Plus, by the way, the cost of a well, just like a lot of things like building a house, the raw costs have gone up so much that the actual profit isn't as great.
Right. But there'll be a lot of political pressure saying that this is really the result of policy as opposed to the desire of shareholders that is keeping production from what it could otherwise be. Would seem that might not be correctly placed. And we talk about it every day, the desire for buybacks and return of capital through buybacks and or dividends is really what's motivating many of these companies not to increase production dramatically.
Totally right. You've got the president saying, listen, we will commit. You would have to have a lot of different moving parts go to be able to make it so Europe has enough natural gas. But the easiest one would be is to let the pipelines be pipelines. But the FERC, which regulates that, is blocking a lot of the pipelines that the president seems to want.
Guys, let's turn to Apple this morning. A bit down in the pre-market. Sources tell Nikkei the company will cut its planned iPhone SE output by 20% and reduce AirPod production as the Ukraine war with Russia, looming inflation starts to dent consumer electronics demand. They win Best Picture last night with Coda. Katie Huberty with a note today saying, are we on the cusp of moving from shipments and ASPs to monetizing the installed base? She thinks so.
Tim's fought me on that for a long time. If he goes along with the Tim Cook show.
Oh, thank you.
By the way, congratulations to Duke. Eddie Q, much more of a fan even than Tim Cook. But here's equal fan, but one more exuberant. Here's what I have to say about that cut. Tim Cook told me once, he said, Jim, anytime you read a story which says multiple sources have said we've cut because of X, those stories are not true. They just don't do that. So here's this Nikkei story. A lot of people are going to sell Apple. I say own Apple, don't trade it. Pretty simple. Even though it's been up for many straight days. I'm not saying that the story can be true. I'm just saying that the idea that the suppliers are telling the press, hey, listen, Tim has said no, that's just not true. Tim Cook does not do that. Just doesn't.
Yeah. I will add, JP Morgan is looking at lead times, which they say are not perfect, and that's ex-China for sure, but they are on the lookout for maybe shipping expectations that need to be reined in.
Well, if it's 2 million versus, say, what Katie Huberty's talking about, remember, if they start charging a subscription, you'll be getting more and more from this, and you'll be paying more. And remember, there's no bad debt here. Everybody pays. I use a credit card all the time, but I would like to have a bundle credit card. There isn't any. I've changed my password, been hacked a couple times, and I just realized how much I rely and pay these guys the way I used to pay American Express. That's how much I use it.
Didn't Buffett call it one of the biggest values in the world? $1,000 to basically run your life.
It is, and then T-Mobile will pay it for you, right? I had T-Mobile. I have Mike Sievert on. I know he's usually your guest.
Not usually my guest, but I do enjoy having Michael on when we can get him. Yeah.
Right, but he's there. He pointed out that everybody's giving away the high-end phone. That's $1,000. You can't beat it. If you want an Apple phone, you go to T-Mobile, which has the best coverage. They give you the phone. Then you run up the subscription. The bill comes out at 3 a.m., so nobody sees it except for me. And sometimes I see it because I'm going to sleep. Sometimes I see it because I just get up. But there it is.
I think T-Mobile's going to take the first part of your statement there and use it in a national ad campaign.
Yeah, they probably will.
Yeah, they probably will. By the way, we should mention with Apple, I don't know that this moves the stock. The win last night at the Oscars, Coda. First streamer to actually win Best Picture.
It's We Crush that will move the stock.
Excuse me?
There's a WeWork kind of a docudrama?
Yes, I've seen that. Yes.
Well, that could move. That could move anything.
Actually, interestingly, you know, I sat here for quite some time discussing the fact that Apple did not seem fully committed to streaming, really questioning the robust nature of their catalog.
No, many
but
times
they
I've disputed you on this.
And I think it was true, but they have obviously stepped up a lot in terms of their spending. And by the way, the big movie that really, in many ways, got a lot of people's attention was when they actually spent on Emancipation.
Yeah, I know.
And you know, that's their next really big movie, and you know who the star of it is.
Do you hold it up when you want to be?
The star of it is Will Smith.
You went there.
No, I didn't.
I was just telling you
to go there. That
I mean, how could it's the first thing I read this morning?
I'm just telling you that Will Smith's next big movie, and I know because I know some people working on this movie. It's a huge movie, Emancipation. It is going to be on Apple TV. When they signed the deal and they had a lot of competition, it was a notable story at the time because it did show that Apple was really a competitor here. Of course, the bigger question for Apple as we watch is, do they ever consider trying to acquire anything to continue to bolster their efforts there, or do they simply grow this organic? It has not been their way at all.
Eddie Q, who just is having the time of his life, and Tim Cook loving shows, who he's always loved series and shows. I mean, look, they're great consumers of it. They always said, listen, don't rush us. Now, do you use, when you sign in, do you sign in with the QR code? How do you sign? And you want to get the...
I read books. I don't really watch any TV.
What, the investing club? What are you talking about?
No, you can go when you go to be on Apple Plus. It's very simple now. You know, you just go like this.
Can I put it to my TV?
Yeah, it's just so easy. You wouldn't believe it.
Oh, yeah. We do AirPlay quite a bit.
I love it. See, boom.
That's
I got
good
it.
to know.
Do you want to run that Will Smith clip again? Because I've got this.
By the way, we turned
it
off at like 10:15. We missed it. You know.
Yeah. A lot of people. I did the same thing, but definitely getting reminded of the move today and what it may mean for Hollywood down the road.
I'm just here. Who is more scared of nuclear war after the regime change comment?
Excuse me?
Regime change comment by President
Biden, yes.